Good evening. It's the Oak Bloke here. So just going to spend a bit of time looking at Obscura. So this article, I've recorded a video before. You've seen this article before. So um, the dude with the breathing apparatus. Um, I mean, the reason I'm re-recording, or not really re-recording, the reason I'm recording an updated video, and I'm going to try and make this short and snappy. I've not rewritten the whole article. I've not produced a new article. I just wanted to share a couple of insights that I'd kind of clocked today, and just felt quite excited about. So none of this is advice. This is just me talking about my thoughts, and you make your own investment decisions. But yeah, look, this is my perspective. That couple of things to point out for you to think about. So just kind of quickly recap on the previous article. So there was a month. This article was a month ago, just over a month ago. This was when it was at 2p, and there was a question of should you follow on into the fundraise that they were doing, the secondary placing, or stay clear, or sell out, or what should you do? And I participated. I decided to participate, and the reason I participated and decided to was a couple of things really. I kind of looked at the numbers, looked at the dilution, then looked at sort of, if I participated, at what point would it mean that I was essentially not being diluted, because what you were losing was you sort of had 0.39 pence of a, sorry, 0.39 cents of a share, excluding the intangibles. So what that means is the technology, the intangibles is the technology and all the IP. Assuming that that's all worth zero, which of course is pretty silly because it's of course worth something. But let's just assume that that's worth that 5.5 cents there, which would take it to almost 10 cents a share. So 5 times more than it was for sale for back then. Um, let's just assume it's the 0.039, which is the cash, the debtors, the stock. The the tangible stuff is the TNAV. Okay, the tangible NAV. So after dilution, because basically we're going to raise, as you can see here, some millions. Some 5.4 million worth of shares, but then because that would double the number of shares, it would reduce your share of those assets down from 3.9 to 3.16. So you would lose 0.73 cents of a share, which is about 20%. But if you participated at the 2 pence, then that was sort of, you were paying 2.5 cents to get 3.9 cents. So there was a break-even point where if you added 109% of your prior holding, you would sort of essentially break even. Okay, or 111% on a TNAV basis. Anyway, that's what I decided to do, because I looked at it. I said, do you know what? Actually, other people are doing the same thing, and the other people being the smart money, which is various high net worth people, some quite high profile. You've probably heard of Simba mattresses. You've probably heard of Saracens rugby. You've possibly heard of Domino's Pizza. So these people are sort of high net worth individuals that have invested in things. So obviously they know a thing or two. You can judge that as you will, but when you've got people that are, this chap here, Mr. Magic, as he's known, is adding 50% to his holding back last year. Ellie Basil Victor Dangor has 10 times his holding, and so on. So there's quite a few additions, and also new institutional investors adding in. Anyway, the news today, and the reason I'm doing a further recording, was I looked again and I was like, wow. So look, all these people here that had, Ellie Dangor, 5.4 million shares, is now at 32 million. So they've 6 times their holding, 6 times their holding. After 10 times in their holding, they're now doing another six times their holding. Sorry. Oh yeah, looked like I didn't have fingers for a moment there. I don't know what was. Oh, I don't know. Anyway, sorry. I yeah, just looked at my hands and it looked like I had no fingers. I don't know whether the video was going a bit too lally, but anyway, um, I do have fingers. Just, I'm holding them up just to make sure. Um, yeah, uh, anyway, yeah, John Gunn, has increased his shares by 20 million, so has gone from 12 million to 31 million, and so on. So there's some really big lean-ins into this idea. Um, a third institutional investor here, RBC here, a fourth institutional investor. So four IIs and several high net worths. I mean, you read into that what you will, but I'm reading into that uh, yeah, like these people are not dumb. These people are clever people that um, I don't know. That's a lot of commitment into something that appears to be sort of, certainly from a share price point of view, appears to be in trouble. I mean, it's dropped 25% since I recorded that video, so it's now at 1.5 pence. I added today at 1.57. uh, was that a good idea or was it not? I sort of sat there for a while thinking about it, but when I looked at the holdings and the additional holdings that other people had added, I thought, okay, that tells me something. That tells me something. But here's the other thing that I saw, and there was a couple of things. So I'm going to try and cover these really quickly with you. They're all in this article, so it's the same article as the one from a month ago, belly aching for the future of Scura. Everything else is the same, but the bit that I've added in is here. Um, so this was from Inogen. Inogen being the one of the competitors that I compare in the article. So they've got various different systems. They've got the G3, G4, G5, Rove 4, Rove 6. All of these I noticed today are pulse devices, pulse oxygen. They're not they're not continuous flow. If you go and look at their product range, nowhere on their website are they advertising a continuous flow device. Why is that? Why does that matter? Well, it matters because if we go and look at the word continuous flow, which is here, they do say to us here, we market our own 5 litre Inogen at home capable of continuous flow of oxygen. Um, so they talk about it, but they don't advertise it. Why is that? Is it because the the ones that are the market leaders are the ones that they're advertising? Like, there's got to be a reason that you wouldn't advertise one of your products. So, is it that it's not terribly competitive? Is it that I don't know, you tell me, but this stationary at home, at read the words, at home, that is not a portable device. So the problem with all the other devices out in the market is that they are like, you know, 20 kilos, or and I'm not exaggerating either. Some of them are literally 20 kilos, where, if you were somebody that was a fit weightlifter, you would struggle to carry that around with you as you went out and about. It would not be portable. For somebody that's got breathing difficulties, well, you can just, I mean, it beggars belief that they would use that portably. They just wouldn't. They couldn't. It's not physically possible for them to do so. So they need a device that's light enough for them to carry, but some people do need continuous flow, even on a portable basis. Well, folks, this is not it. This is you stay in your bedroom every day forever if you've got one of these devices, as far as I can tell. I don't know that for sure, but I've not been able to find anything that contradicts that perspective or opinion. Um, happy to be corrected if I'm wrong, but I don't think I am. In other words, this is nothing like the Discover from Belluscura. Now, the Explore versus the Inogen Rove thingamajigs and the other products that they have, like you could say, well, you could play top trumps. Oh, well, this one's got this many settings, this one's got this many hours of battery, this one's got this one's got that, and they're all kind of pretty competitive with one another. And um, Explore is better at some bits, and Inogen is better at other bits. And so, like there are people that could sort of go, oh well, it's got only 6 settings, not 8 settings, so it's only got this much, liters per minute of oxygen. So there's top trumps that you can outsmart and outclass the Explore, but fundamentally they do not have a product that goes across portable and stationary. All of these five are portable, only portable. They do sell a stationary, they don't show it, which suggests to me that it's not market leading. And it's only mentioned in passing on their quarterly filing. So I think that's really significant. It's also significant. Oh, and it's not here in their presentation deck either. 5 products, no more, are spoken about. Okay, only 5 products. However, if you go under the so they talk about their um, now, Belluscura talked about having 2 classes of Medicare claims that they can do, the portable and the stationary, and that the Discover qualifies for 2. And the fact it qualifies for 2 is why they're very excited. So let's kind of dig into that, because I've put this on the on the website, but I mean, just showing you this you might not understand the significance of it. So look, 9642, if you're in a non-rural area, this thing here means that it's stationary. This thing here means that it's portable. So if you've got a portable device, you can claim from the government $47.51 a month. If you've got a stationary device, you can claim $96.42 a month. Okay, so over the course of 12 months, okay, um, let's grab the good old calculator. Okay, so you can claim $1,157 from the government for a stationary device, and you can claim 570 for a portable device from the government. Okay, in a non-rural area. If you're in a rural area, it's you're incredibly better off for whatever reason. So 173 times 12 is 2079. So it's nearly double what you can claim if you're in a non-rural area. Anyway, um, and then this 151 is about $700. So I mean, that is the reason that these equipment distributors that we've seen RNSs about are saying we want to buy Belluscura and we only want to use Belluscura, is the idea that they buy the device for, let's say, $3,300, and then they can claim, well, somewhere between $1,100 and $2,000 from the government for a stationary device, or between 500 and 800 a year for a portable device. So for a device that costs 3,300, I mean, you make your money back in about 18 months. Okay. And the device itself has a 3-year life and then needs replacement parts and different, it's not all profit. These things don't last forever, but they've got a 60-month life, 5-year life. Some parts, cartridges and things obviously need replacing sooner than that. But the idea is that these are reasonably profitable, and these reimbursements are before any rental costs to the end user. So if they're charging, if they're just sort of giving the device for free, fine. But if they are actually saying to the end user, like your cost for this device is $30 a month plus the Medicare contribution, they're obviously making more money still. But I mean, this is the thing, that the reason why Discover is going to just fly off the shelves, at least in America. I can't, maybe not so much for other countries, but certainly in the US. And the reason is simply this. Go back to the RNS and read what it says. We can claim for two codes. So, I mean, let's imagine that they're in a rural area. So we're saying they can claim 2079.84, okay, plus 12 times the 5163. Oops, I don't think that's quite right. So if we do that times 12 is 620 plus the 2079.84. So they're getting the best part of 2,700 for one device that's costing them 3,300. So the payback on that device is about 1 year and 2 months. Whereas if I mean, I don't know how much the gadget from Inogen costs, but I do know that the Inogen Portable is more expensive than the Explore. So, I mean, if you're buying two devices from Inogen, and let's say the stationary one is, well, let's say it's the same price as Discover. I don't think it will be. I think it will be more expensive, but let's say it's the same. So you're going to pay the best part of what, $6,000 instead of $3,300. So it's twice as profitable for a distributor to buy from Belluscura as it is to buy from Inogen, as far as I can see. Okay, that the reimbursement levels are such. I mean, these are the numbers quoted by Inogen as the Medicare, and these codes are definitely the codes that Belluscura talk about. So I don't think I'm wrong on this, but that is just, I mean, when I saw these numbers, I thought, wow, and we're only really talking about them selling, I mean, to get a turnover of 13 million, which is the estimate for 2025. I mean, at 3,300, we're only talking about selling, sorry, I think I've done too few zeros. We're only talking about like fewer than 4,000 devices. And I mean, obviously, if there's some of that's Explores, then maybe we're talking 10,000 devices. But we're not talking about vast volumes of sales to kind of get to this level here, 12.7 million. So I said 13, but 12.7 with that level of margin, which again is similar to what Inogen's margin is. I mean, it was encouraging to see that the Inogen margin is not vastly different. Their margin is about 46%, and it's risen, but 46.7% margin, and then the rental margin they're making. Oh, by the way, these guys do rent as well as, so Belluscura would be different in the sense that they're not planning to rent, they're planning to sell to people that then rent, if you follow me. So but they're making 43% margin on what they're selling. So I think this is incredibly encouraging. Was the sort of thing that just to summarize. Okay, well, look, that was pretty much it. But that's why I've added to Belluscura today. I do sort of, I mean, when you look at the market size, I mean, this, I think this bit here, we're sort of, we're sort of saying that that it meets both the reimbursement code. So I'm consistent with what I'm saying to you, that we're, yeah, that 1,200 per quarter would be equal to like less than 0.1% of Americans that are supported with Medicare. So, like, 1 in 1,000 is doesn't seem a stretch to me. Anyway, that's everything from me. I don't think I've added anything else. Everything's still otherwise the same. So I hope that's been useful. It's just my opinion, but it's certainly some encouraging thoughts, and obviously what we need to see now is some results, and we need to see sales growth, and we need to see scores on the boards. And I think as soon as we start to see that, I just don't think the share will be at £1. Sorry, £1. It'd be nice to be back at £1 this time next year, Rodney. No, look, I mean, put it this way: if it can achieve what I'm saying, these estimates here, I mean, even if it next year can get to break even, um, with the idea that it's got what 50% growth. I mean, when you sort of extrapolate that out to 2027 at that sort of profit margin, and so we're adding what's 27, so that'd be 13 and a half. So that's sort of an adjusted EBITDA there of $4 million. I mean, let's just say, just for the sake of argument, that it's got a pretty secure runway. It's got sort of new agreements. I think you could put 20 times adjusted EBITDA on that, and that would get you to 80 million. Okay, and 80 million, um, 80 million. I mean, let's just sort of work through what that would mean. So 80 million. If we turn that back into pounds, it's 61 million. So I mean, we're talking 10 times today's share price. Or another way of looking at it is, if it can achieve an adjusted EBITDA of 4 million in 2027, that essentially you're buying it today at 2 times its future earnings. So in other words, for every dollar of profit, of EBITDA profit that it earns, um, for every dollar of EBITDA profit, so what was I saying? Yeah, so for every dollar that you invest in this, it's generating 50 cents of EBITDA earnings, which obviously once you take tax out and depreciation and so on, I mean, I mean, let's say it's 20 cents, or for every pound it's 20 pence. So it'd be a price earnings of 5. I mean, at today's price, if it can do anything approaching that, if it can hit profitability, the re-rate on its potential is massive, colossal, absolutely colossal. So this is why these people have leaned in and bought, some of them tens of millions of shares, is that if this works out, yeah, the return on it's massive, but obviously the risks are there as well. I mean, it's obviously disappointed for a long time. I mean, if you bought it back here, at the top of the market here, I mean, you would have paid what, £1.30. So today you would have lost nearly 90%. No, sorry, 99%. You'd have lost 98 point something percent of your money. So yeah, there's definitely risks, but when you look at the rewards that, and and look at where it's achieved, it's got production, it's got the patents, it's got the cash in the bank, it's got the working capital, it's got the sales growth. It's telling us that they've doubled sales in 2024 for some of the months, that they and they could have sold 4 million if they'd had the working capital. They could have sold 4 million in Q4. That there was enough sales to make 4 million. I mean, 4 million would be above that and below that, and that's kind of what could have happened had they had the money last quarter. Well, not, yeah, last quarter. Yeah, and at 4 million turnover, I mean, you're just below break even, just below break even. So yes, there's a risk, but there's quite a lot of mitigation to the risk as well. Anyway, that's enough from me. Hope that's been useful, and that's Belluscura. Thank you for watching. If you want to read my articles, they're at theoakbloke.substack.com. And thank you for watching. Have a good evening. Cheerio for now. Cheerio.